Hey guys, Clint Coons here. And in this video, we're going to be discussing how to structure your California real estate because I've been getting a lot of questions on what California residents can do to avoid the dreaded franchise tax on business entity structure. Okay, let's get started. So you have California real estate or you live in California and you're probably aware of this, that if you try to set up a limited liability company, you've heard that for each LLC that you have, you need to pay $800. And it gets worse. I mean, we're not only talking about California real estate, but if you're a California resident and you own real estate in Texas, New Mexico, Florida, California has taken the position that it can tax each of those entities as if they're doing business in California. What I mean is if they're doing business. They say they're doing business in California. Yeah, the Franchise Tax Board is of the position that if you're a resident of California and you hold a membership interest in a foreign LLC and you can control it or you exercise management decisions, California wants a piece. They want $800 because that LLC, in their opinion, is doing business in California. Now, for many Californians, this has actually discouraged them from creating structures because think about what I've been teaching. You know, one property per LLC. You have 10 properties. What is that going to amount to? $8,000 a year? Now, don't get me wrong. You know, even at $800 an LLC to protect a property that's probably worth $500,000 if it's in California or maybe $120,000 if it's in Florida, that's still not a bad investment to know that if something goes wrong, you're going to be protected. But again, it's a hard check to cut come every year when California wants that money at the beginning of the year. So what can we do then for California residents, people who invest in California, to eliminate this issue of having to pay that $800? Well, there's a couple different strategies that you might want to consider when it comes to protecting yourselves. Number one, there's been a lot of talk about this. I cut another video on it. It's called the Delaware Statutory Trust, or what we like to use is a Wyoming Statutory Trust. So with the statutory trust, it's not subject to the franchise fee because it's not an LLC, it's not a limited partnership, it's not a corporation. So if you live in California and you're investing, I don't care if it's California, Florida, Texas, New Mexico, rather than set up LLCs, you may want to consider this Delaware statutory, or what we like to create a Wyoming statutory trust. Now, if you haven't watched my video yet on that particular tool, I'll just give you a brief example of how it's set up. So with a trust, it's going to be created in the state, say Wyoming. So you create this Wyoming trust. Now, like an LLC, it has to be registered. So you have to file something. It's unlike a land trust. It does not have to be registered. With these particular types of trusts, they do require you register it with the Secretary of State. So you have a registered agent there, you have an address there. So you create this trust and you have to have a Wyoming trustee. And typically what we're going to use in that case is a Wyoming LLC that you control to be the trustee of your trust. And then you're going to be down here as the beneficiary. Now, the statute reads that if anything goes wrong, if you get sued personally, unlike a situation in a land trust where you're to be sued personally, they can take your trust from you. In Wyoming and Delaware, if you're a beneficiary and you're sued, they can't take your trust from you. They can't get up into the assets. The trust has charging order protections. Hell, that sounds a lot like limited liability companies, doesn't it? In fact, I think they modeled it after this. But the other benefit is that when you have property inside of there, it works the same way like an LLC. So if something goes wrong and somebody sues, then it stays contained within that trust. Okay, so from a California perspective, then how does this work with the franchise tax? Well, it doesn't apply because the franchise tax only applies to those business entities. It doesn't apply to trusts. So by using this type of structure to hold your California real estate, setting it up in trusts rather than business entities, you're avoiding that dreaded tax. So just think, 8 trusts, that just saved you $6,400 by setting it up with trust versus a limited liability company. All right, now, is there a catch? Well, absolutely. I mean, you're probably thinking this is too good to be true. Well, the point is, when it comes to using these trusts, there are some unknowns. How would another court interpret its use when you're using a trust that provides asset protection to hold title to real estate in a foreign state where it's not located? I mean, we can all agree if this was a Wyoming trust holding Wyoming property, there's no question there. But what happens when you take a Wyoming trust and you use it to hold property in California? Where does that place you? Or a Delaware statutory trust use it to hold property in California? Well, the issue is that these trusts are looked at as business trusts in the eyes of California. So when you use this type of trust in California, you will have to register it there. There's a separate process to register business trusts in California, so you do have to get them registered. And then the question becomes, do they want to tax it or not? California, I've looked at the law, and I tell you, it's clear as mud on this. It appears that they may tax them as corporations, California corporations. You're not going to have to pay that minimum $800, but you may have to pay tax on the income. So that's something that's a little unclear. The other thing I think is even more important here is how the court would recognize it if you're in California and you own property there. How would they treat that trust from an asset protection standpoint? Or if you own property, like I said, in Florida, and Florida doesn't recognize this entity by statute, how would they look at it? So there are some questions on using the trust. I'm not saying you shouldn't. I think that you could use this vehicle and then possibly wrap it in a Wyoming LLC, make the Wyoming LLC the beneficiary of that trust and have multiple statutory trusts set up that way, just as an ounce of added precaution. Now, if you don't want to go this route and utilize the trust because you're just not someone who wants to be the guinea pig, the test case when something goes wrong, I got another solution for you. Okay. Now, in this scenario, we don't have to use the trust. Instead, we're going to use an entity that's been around for a very long time. In fact, it's a precursor to the limited liability company. This was the entity that people used to use all the time to protect their real estate until the LLC came along. The entity I'm referring to is a limited partnership. Now, if you look this up, you talk to a CPA and you ask them, I'm living in California and I own real estate in a limited partnership. Is it subject to the franchise tax? They're probably going to tell you it is. Now, the reason why is they may not be aware of the recent Franchise Tax Board ruling on limited partnerships that are set up in a very specific way. So let me give you a little background now on the limited partnership and how it typically is set up and the tweak that we use to avoid the problems associated with that traditional method from the California franchise tax aspect. Okay, check this out. So you've got a limited partnership. Now, the thing about the limited partnership, when you set one up, it's a great tool. So if you put property inside of here and something goes wrong, it's going to stay contained inside of that bubble. It'll stay in there. And you're not going to be sued personally because you're going to be down here owning this limited partnership as a limited partner. Okay, so that means you have liability protection, LP, liability protection for this limited partnership. Now, a limited partnership also has to have a general partner, somebody who controls it. So who's going to be your GP? Well, you might be thinking, hey, I'll be the GP. I want to be in control. It's my real estate. Well, most people don't want to do that because if you're the general partner and something goes wrong in here, it's not going to come sue you as a limited partner, but they'll sue you as a general partner because general partners, they're liable for whatever happens in a limited partnership. So it discourages individuals from wanting to be general partners in their own name. What do we do instead? We typically create an entity up here. This could be a corp or LLC that you run as the general partner of your limited partnership. So when you record this document, when you file for the LP, you state, hey, this is the GP, I am the limited partner. Okay, so a limited partnership, because there's two partners, it's treated as a partnership for federal tax purposes. And when it's treated as a partnership for federal tax purposes, then California is going to nick you for $800. Okay, and this is how they've always been set up for a lot of people, setting them up with two partners like this. Well, most individuals are not aware that the IRS allows you to set up a limited partnership and treat it like a disregarded LLC. I mean, it's confusing to individuals because they say, no, that's not possible. A limited partnership is a partnership. It has to file a tax return. It does in a lot of circumstances like this, but There's a way to get around it if you know where to look. So the IRS has acquiesced, and they have stated that so long as the taxpayers, that is the GP and the LP, are the same parties, if they're the same parties, then the limited partnership is a disregarded entity for federal tax purposes. Okay, now you're probably trying to digest that right now, trying to figure out, what did I just say? I get you. So here's what we got to do there. If we want to make it the same party, one way to do it would be to say, all right, we've got husband and wife here as a limited partner, so we're going to make husband and wife up here as the general partner. So we have both individuals in both places, right? What's the issue with that if we did that? Well, liability, okay? So if you're going to be the general partner, you have to take on liability. Now that kind of defeats the purpose of setting this up from an asset protection standpoint. Okay, so then what entity can we set up that will give you liability protection and you don't have to file a tax return for it? You can make it a disregarded entity. In fact, I already told you this answer. It's a limited liability company, right? We can set up disregarded LLCs, and in order to do so, you have to either have one owner of the LLC, or if you live in a community property state like California, and you have a husband and wife or a married couple, they can serve together in that LLC, and it would be disregarded. So here's what we do. Here's the strategy. We create a limited liability company to make it the general partner of our limited partnership, and we make this one a disregarded entity. So that means that this entity is disregarded for tax purposes down to these two individuals. So the IRS looks through it. They don't treat it as a separate partner. It doesn't have to file a tax return. Now, because we've done that, it's disregarded to these individuals. We've then set up an LP that can also classify itself as a disregarded limited partnership, because these individuals and this individual, they're the same taxpayer. That is the strategy you need to use. Now, that gets us to the point where the IRS says it doesn't have to file a tax return. So how does California fit into all of this? Well, last year, just for perspective purposes, in November of 2019 or early December, I don't recall exact date, there was a franchise tax board rule. And this issue came up. An individual had set up a disregarded limited partnership, similar to how I described, and they argued that their limited partnership was not subject to the franchise tax because the franchise tax, the tax code only speaks to disregarded LLCs being subject to the franchise tax. It does not state that limited partnerships that are disregarded have to pay the minimum franchise tax of $800. And you know what they said? You're right. They don't. So this opens up a whole new planning opportunity for individuals that when you create a disregarded limited partnership in the way I just described, using an LLC and an LP here and the same taxpayers in both positions, then that entity is not going to be subject to franchise taxes. So here's what you could do. You could set up multiple LPs in California, just like this, to own your rental real estate. If you have California real estate, all general partners, the same thing. It's all going to be that one LLC that we've set up. And let's say we set up another one over here in Texas, LP, right over here, owning property. And again, you got it there. You could have this entire structure, and not one of those entities would be subject to that $800 franchise tax. This is a blessing for Californians. They can finally get out of having to pay $800 on an annual basis to have a structure to protect their assets, now that the government or the Franchise Tax Board has acquiesced and said that the law does not apply to disregarded limited partnerships. Great strategy. Okay, I was so ecstatic when I came upon this and I read about this ruling. I thought I just had to share it with people. Now, the reason why I didn't come out right away with this is because you never know. Are they going to pull this back and make a change to the tax code? So we've been following the law this past year during COVID to see what changes have been made. And thankfully, although the Franchise Tax Board proposed some legislation, that was not picked up and nothing has changed. So here's the asterisk disclaimer. Okay, although this is a great strategy and it can work for you, you have to be aware that they could change the law at some point in the future and try to bring that back in and say disregarded LPs need to be treated like disregarded LLCs and we need our money. I don't know if that's going to happen, but if it doesn't, this is a great alternative for you if you invest in California. I mean, what do you got to lose? Think of it this way. If they're going to tax your LLC anyways, Why not go with this route and set it up, because they may not change it. And then you'll be in a great position. Federal taxes, it's all disregarded. We can talk about that if you want to get more creative on what we can do with the money, as far as if you want to get partnership taxation. There's other things on the side that we could look at. But one other thing about this, if you're going to set it up, it's somewhat technical on how you apply to the Franchise Tax Board to meet the certification as a disregarded limited partnership. So we've been doing this for some of our clients now to set up their structures, and it's working quite well. Be sure to check out my other videos on Delaware Statutory Trust if you're not sure about how that entity works, so you can familiarize yourself with that particular tool. But all the best with your investing, and stay safe, everyone. Hey, if you like this video, also give me a like down at the bottom, and be sure to subscribe to the channel as well. Take care.